All righty then. Hello, everyone. More this and that. Uh, we're going to look at something that relates to the class unity sessions we've been attending. And this is about Hyman Minsky's work. And they didn't really cover that much. But what's useful, of course, is there's continuity. And I'm going to show a short video, which is essentially a unit, one of those teaching units that's necessary, and it does all the same things. If I were going to yammer through Minsky's several versions of the same idea, that is the financial instability hypothesis. Let me do a brief introduction, and then we'll go to the video. Video is, I think, only about 10 or so minutes. I put in on the little page a second video that has Steve Keen talking about Minsky's financial instability theorem. So why that's useful, of course, is because Steve Keen is going to come and talk to the class unity folks. I don't know, I can't remember if it's next week or the week after that, but it's, I think, useful to point out that Steve Keen named his own little modeling software Minsky. So you can see that there is a definite relationship. I'm not a macro person, but you need to know macro in order to figure all this stuff out. And Steve Keen's model is mainly a macro model for a variety of reasons. And of course, the Marxian model itself, as a suggestion about the questions of crisis, et cetera, is a macro model. So it's not like it disavows macroeconomic models, but not all Marxism is macroeconomics, as I hope you appreciate. And therefore, I'm going to just read this one paragraph. We'll go to the video and then see whether we have enough time to do some of the Keen video is an hour and 20 minutes, and we don't have to watch the whole darn thing. And in fact, it's probably repeats some of this anyway. We may just have time for a discussion and then move on to other matters. The financial instability. Oh, and noting, and I will remind you that Minsky is really important. Minsky probably should have gotten a Nobel Prize. And Minsky's theories are not unconventional theories. In fact, they really fit actually into perfectly into a discussion of the 2008 great financial crisis, simply because it comes closer to incorporating what one might assume to, well, you can call it a post-Keynesian thing, but Marx was pre-Keynesian, but you could also say that Keynes has a certain position on the role of the state and fiscal policy that is not all that different than certain other kinds of modeling. And this is that sort of double coding that Minsky applies. And of course, from a classical or neoclassical model, you can see how that is uncomfortable for some people to move in that direction. Steve Keen is also seen in that, there is just this heterodox modeling out there that grows a little bit, but only it fits and starts, because the dominant model, as it is taught, is a neoclassical model with the usual variations. So the first paragraph, the financial instability hypothesis has both empirical and theoretical aspects. The readily observed empirical aspect is that from time to time, capitalist economies exhibit inflations and debt deflations, which seem to have the potential to spin out of control. In such processes, the economic system's reactions to a movement of the economy amplify the movement inflation feeds on inflation, and debt deflation feeds upon debt deflation. Government interventions aimed to contain the deterioration seem to have been inept in some of the historical crises. Now, this is written in the 70s. These historical episodes are evidence supporting the view that the economy does not always conform to the classic precepts of Smith and Vahra. They implied that the economy could be best understood by assuming that it is constantly an equilibrium seeking and sustaining system. So with that, we'll go to the the video. Damn it.
Hi there, and welcome to another in our series of short videos looking at aspects of financial markets and financial instability. In this session, we're going to look at the work of a particular economist, Minsky, who came up with the idea of his financial instability hypothesis. And Minsky's life work was to better understand the causes of financial instability, particularly in sophisticated capitalist countries. And his research came into prominence again when the global financial crisis engulfed many countries from 2007 onwards. The essence of the hypothesis is that over periods of lengthy economic prosperity, when incomes are rising and more people in work, what tends to happen is that the people working in financial institutions decide to invest in ever riskier assets in search of better returns, higher profits. And that this period of stability and increased leverage in the banking system can make the wider economic system much more vulnerable if debt default materializes. So according to Minsky, when bad economic news eventually happens, the financial system is at great risk of being too highly leveraged. In other words, there's too much debt relative to capital, and there is a risk of systemic collapse as asset prices such as housing values start falling, people lose their jobs and real incomes go down. So Minsky argues that essentially the financial system in capitalist economies is inherently unstable. Let's work through the essential arguments that come together to form the Minsky financial instability hypothesis. So take an economy initially that's currently in a phase of pretty robust, pretty strong growth, doing well, with low inflation and rising employment. Minsky calls this the period of tranquility. But this economy is doing well, but has debts from previous cycles. So what tends to happen, first of all, is that the strong economic growth increases the profits of commercial banks. They're lending out to businesses and households, and they're paying interest and making a profit on their loans. The economy is growing strongly, so rising incomes and more people who found work helps to make the debt that people have taken out more serviceable. So as your income goes up each month, you find yourself better able to pay the interest on a credit card or the interest on a mortgage or other form of debt. But the crucial point is point 3. When an economy is going through a strong growth phase, the lending criteria, the credit criteria that the banks may have used in terms of deciding who to lend to, the lending criteria that was considered prudent in the past, they tend to be relaxed. The banking system becomes a little bit perhaps overconfident in terms of who it lends to. An example of this could be the subprime lending boom in the United States from sort of 2000 onwards. Therefore, point 4, there is a significant increase in the supply of credit through new loans, and that increases the leverage of the banking system. Leverage is a measure of debt relative to capital. The boom in credit drives growth in the short term. You get a cyclical increase in GDP, but it also causes a significant increase in asset prices, for example, share valuations and particularly property prices. Now, this credit boom leads to an increase in household debt to GDP and corporate debt to GDP, and the increased debt to GDP ratio amplifies the risks for an economy if there is a sudden negative external shock, which brings the growth period to a close. The Minsky hypothesis, the essence of it is that once the system is highly leveraged, once the commercial banking system and the wider financial system has lent out so much money, only a small increase in bad debts can then make the system extremely unstable and at risk. We saw this in the United States. This chart shows the share of non-performing loans held by banks in the United States over a 20-year period. And the period from 95 to 2007, you could argue, is the period of stability or tranquility, very low level of non-performing loans. that's a debt on which creditors have not made a payment in more than 3 months. Then look and see what happens in 2007, 1%, 2008 above 2%, and suddenly, before you know it, in 2009 into the recession, 2010, the share of non-performing loans in the States rises to above 5%. Well, a low figure compared to Italy and Greece, but compared historically in the United States, a huge figure. That, of course, triggered the wave of bank losses and bank failures, which we know much about. So the Minsky hypothesis is essentially the dangers of financial systems overextending themselves, becoming too confident in the upswing phase of the cycle. Here's a nice flow diagram showing
so when asset prices,
the credit
housing
cycle,
going
if you
up,
like, and the
people
upswing of
have the
asset prices.
expectation that those prices
When
will
asset
continue
prices,
to go up.
particularly housing, are going
The
up,
banks are making
people have
profit
the
on them.
expectation
Their
that those
confidence
prices
is
will
high.
continue to go up.
The
The banks are making good profits on their mortgage lending. Their confidence is high.
They
Demand for
relax
credit
their
is
credit
increasing,
risk,
and
they
banks are
relax their
then more
lending
willing to
criteria,
lend because they
increases the
expect to make higher
supply of
profits.
credit.
They relax their credit
You
risks.
have
They relax their lending
feedback.
criteria and expectations. Positive expectations in animal spirits, both on behalf of lender and borrower, lead to a big increase in the supply of credit. The big danger of an upswing is you get a significant oversupply and over demand for credit. But then things can go badly wrong. We then fall into the downswing phase. Lenders foreclosure, so the market supply of loans starts to contract.
Hello? Is there an echo? Is there a problem? Hello?
I think it was okay now.
Okay.
Yeah, no, it's fine now.
Let's see if we can get this back.
We then fall into the downswing phase of the asset price cycle. House prices perhaps start to fall. Lenders start getting nervous that some of those mortgage loans will not be repaid. Perhaps they start to call in some loans. We call that a mortgage foreclosure. So the market supply of loans starts to contract, and we call that a credit crunch. And in a systemic credit crunch, nearly every lender is either stopping or limiting how much they lend both to commercial customers, households and businesses, but also how much they lend to each other in the interbank market. So asset prices falling, non-performing loan percentage goes up, as we saw in the States. There's a significant increase in bad debts. Banks have to take a hit. They're making bigger losses, having to write off some debts on their balance sheet, and as a result they're less willing to lend out. The supply of credit gets squeezed in a credit crunch, and as a result there's less money flowing into property and shares, and both valuations start to go down. Crucially, as bad debts and defaults go up, the profits and the capital reserves of the banks take a big hit, and indeed many banks may fail because of insolvency, and also because they run out of cash liquidity. The big dangers of a downswing, particularly in an over-leveraged, over-borrowed financial system, are bankruptcy, default, and a residual debt overhang which hangs over the system for many years. So the Minsky financial hypothesis is financial instability hypothesis. It's an important idea. It's gained in prominence in the last 10 years. It's probably more relevant to developed countries rather than emerging countries. Although people are now looking at China and asking whether or not there's a Minsky moment on the way, perhaps in 2017 or 2018. The lesson from the Minsky hypothesis is that the private sector, commercial banking sector, when it becomes overconfident and extends its loans too readily to people who can't really pay them back, can sow the seeds of a wider systemic instability in the financial system. And ultimately, all of us pay for that.
Country A's share prices have been going up.
What happened?
Okay, back again. Hello. I think it's a bandwidth problem on my end. I've decided that that's the problem. Are you all there? Anyway, we got to the end. Did everyone see it till the end?
Yeah,
Oh,
I did.
Yeah, I heard most of it.
I put the link in there in case anyone wants to watch it from the beginning. It's very short.
We can watch it.
I don't know if you want to watch it again or you want to watch the much longer kind of version of it, which has
I have
the
go ahead.
the guy who's going to speak in the class unity session on either this Sunday or next Sunday or whatever is Steve Keen, who is in Australia, and he's kind of the big deal about sort of post-Keynesian macroeconomics. And as I've mentioned before, for those who came in late, the software that he uses to model all these macroeconomic dynamics is actually called Minsky. So, I mean, this is the deal. And Keen is seen as kind of a dissident, let's put it that way. Some people might call him a crank, but he's the same guy who took on Nobel Prize winner, what's his name, Nordhaus at Yale, and said that all of his predictions about that everything was going to be okay if climate change went to 4 degrees Celsius, and he just sort of blew that shit out of the water. And, I know they're not going to take back Nordhaus's Nobel Prize, but Keen is sort of seen as, you know, a little bit of a maverick in that sense. He is a post-Keynesian. He doesn't claim that he's a Marxist, but he's clearly working from a Marxist position on this. And he's a very popular guy. So we'll see him soon. We may see the second part of that little exercise. So I'm not sure whether are we still?
I have a 1-minute version of the financial crisis I care.
A 1-minute version? You can play it if you want. We're on I think you can share it if you'd like. We're still live streaming.
Unless somebody else has something.
I just wanted to say that I recommend Steve Keen's podcast. It is called Debunking Economics.
Yes, it's excellent.
Yes. Debunking Economics with
There's
Steve
a book
Keen.
too. It's a little technical, but you know.
Debunking Economics, Stephen.
Debunk.
Right, Steve Keen, opposed to Steve
Keen,
K-E. Oh, Keen.
K-E-E-N.
Oh, Keen. This like the okay.
It's called the Debunking Economics Podcast.
Debunking.
The THE, yeah.
Debunking. All right, here's a quick jovial clip.
Collateralized debt obligation. It's important to understand because it's what allowed a housing crisis to become a nationwide economic disaster. Here's world-famous chef Anthony Bourdain to explain.
Okay, I'm a chef on a Sunday afternoon, setting the menu at a big restaurant. I ordered my fish on Friday, which is the mortgage bond that Michael very shorted. But some of the fresh fish doesn't sell. I don't know why. Maybe it just came out halibut has the intelligence of a dolphin. So what am I going to do? Throw all this unsold fish, which is the BBB level of the bond, in the garbage and take the loss? No way. Being the crafty and morally onerous chef that I am, whatever crappy levels of the bond I don't sell, I throw into a seafood stew. See, it's not old fish. It's a whole new thing. And the best part is they're eating 3-day-old halibut. That is a CDO.
We should watch The Big Short.
Just love that.
It is valorizing. That's what valorizing is. It is trying to create value from no value, but for manipulating value. Let's put it that way. All right. Yes. I don't know if I want to try again, considering how glitchy my system seems to be, or the network seems to be.
Or do you want to put the link in and I can share?
Yeah. Why don't we just watch 15 minutes of the second?
Sure.
The second one, and it should be. It's on the Medium page. It's the second one down.
On the Medium page.
It's on today's this
Zoom
and that page. I just put it in chat.
Oh, okay, great.
It's the second video down, and just show about 15 or 20 minutes and then stop. It's fine. It's an hour and 30 minutes, so you know.
Oh, wow.
I'm sure no one wants to watch the entire thing.
I just want to say we should also watch more videos about halibut.
Indeed. We do have to watch The Big Short. We all should just watch.
Yeah, we should definitely just watch it. All right, wait, where? I'm sorry. Levels, daily schedule. Groups. Where? Trying to find it in the
In the chat.
It's in the chat.
Oh, it's in the chat. Oh, sorry.
It's not the link, but it's the second video on the
right. All right, so if I scroll down, okay. See a lot of text. Oh.
It's at the top. It's at the top of the page.
Oh, so if I click on Minsky's financial instability.
That's the first one. There's a one after.
All right. So how do I see the one? Is that further down on the page?
No, it's right below it. There are two videos.
Oh, now, yeah, it just didn't come up right away. Okay. Now I got it. All right. Hold on one second. Let me just open it. Escape. Open it in YouTube. I don't want to do the whole page. All right. Come on.
You may want to open it in YouTube rather than watch it from the page.
Yeah, it's easier. All right. Okay. Sorry.
By the way, my nickname's The Big Short.
All right. Here we go. Share. There's the screen. And you can hear it okay.
Of how his thought came about, how that relates to the economic circumstances he was in when he was a young child and what we're in now. But to go back and ask why does he matter, I think it's the central reason is he asked a different question. The one thing I'm talking about with my students in becoming an economist now is that the question economists fundamentally use to define how they look at the economy really defines what they see. And it's a bit like going hunting. If you ask, where are the wolves? You're looking. You're not going to see the other elements in the landscape as much as if you're hunting for wolves. If you look at the core question that neoclassical economics asks itself, it's pretty much that question: how does a market economy reach general equilibrium? Okay? That's pretty much the mental set that they've always got. They're always trying to work out that particular puzzle. In my opinion, not particularly successfully, but that keeps them still going at it. Minsky's core question was a very, very different one, and he phrased it very well. And that is, can a Great Depression, happen again? Okay? Very, very different question. And he elaborates and said, if it can happen, he's writing this in 1982. So, 30-something years ago, long before the crisis we went through recently, but well after the Second World War, well after the Great Depression. He said those are the questions that naturally flow from looking at the historical record and the apparent success of the 35 years since the Second World War. And he's put it very cogently: to answer this question, you have to have a theory that can actually generate a Great Depression. Okay? So that's a very, very different orientation to the mainstream. Rather than saying how do you reach equilibrium, he's saying how do we reach a depression. And unless your model can generate a depression, in his opinion, it's not a model of the economy, which throws out the whole neoclassical paradigm in that sense, because they're trying to explain why these things don't happen. You know, to them, they're a total surprise. So the reasons for him making it the focus of his economics really relate to a lot of personal circumstances as well as being an intellectual. He was 10 years old when the crisis began, and he was living in a left-wing family. And to give you an idea of that, just how severe the Great Depression was, again, we talk about it, we don't actually, you can't actually experience anything like it unless you go to a country like Greece right now. But unemployment was, the way the unemployment was recorded back when at the end of the 1920s was simply, were you registered for unemployment benefits? They were trivial. But were you registered with the services for unemployment? And the registration rate was so low at the end of the 1920s that literally the recorded rate was zero. Okay? In 3 years' time, it rose to 25%, and it stayed above 10% for the whole decade. So that's annual data up to 1930. You can see the series actually hits zero here. Okay, this is National Bureau of Economic Research record of unemployment in America, and bang, it blows up to 30, 25, 26% of the population by the middle of the 1930s, and there was no dole. Okay, nothing like what you're used to in terms of unemployment benefits or social security back then. And just to give you an idea, this is a lovely graphic I found in Australia, because I'm being Australian, that's where a lot of my information comes from. And the downturn in Australia was about as severe as America, and you couldn't get a more responsible looking character than that guy in that sense. And that was, people actually went what they call the Wallaby Trail then, trying to find work by leaving the cities and walking through the countryside, offering themselves for services at farmhouses and living off the rabbits and the wallabies and so on they found when they were walking through the countryside. It was that severe. You were back to effectively foraging to stay alive. And it began with the stock market crash as well, which is something we all well and truly remember back in 1929. It happened to, the peak of the market happened to coincide with Hyman Minsky's 10th birthday. So if you look at the index, people debate whether the stock market has bubbles. I mean, if you look at that is a classic bubble. Exponential growth in the index hits a peak and it totally plunges. Now that peak to the trough was a 90% fall. And a lot of people who were in the stock market back then had what they call margin loans. Have you heard of margin loans?
Yep.
Okay, hasn't. A margin loan is where you get a loan from a stockbroker. Now the stockbroker has borrowed the money from the bank to be able to lend this to you in the first place. Okay, so it's tied up with the banking system. But you go to a stockbroker and you might have, say, $10,000 to invest. And the broker will say, oh, don't just invest 10, take out a margin loan and invest 100,000. Okay? So it's the 10-to-1 leverage was common back then. And what the margin loan did was, with $10,000 deposit, with this loan, you would buy $100,000 worth of shares. Now, if the shares went up by 10% in value, so they went to 110,000, that's effectively doubling your money. So it's massive leverage. And that's why it was attractive to people. They're told market always goes up. You know, you turn 10,000 to 20,000 by taking out a margin loan. Trouble is the market also could go down, which is what happened drastically in the end of 1929. And when it happens with a margin loan, one of the requirements is that you must maintain the value of the portfolio. So if you've taken out a 10,000, if you put in 10,000, taken out a 90,000 margin loan, had $100,000 worth of shares, and the shares fell by 10%, the value of your portfolio fell to 90,000. And the broker could ring you up and say, margin call, you've got to top the thing up to $100,000, which means you'd have to find another $10,000 to do it. If you didn't have it, they had the right to liquidate the shares you'd bought and to pursue you for anything else they didn't. If there's a shortfall, if the shares only brought back in, well, they'd only bring in $90,000, they had a right to go after you for the other 10. And there was no barrier to what they could take in terms of your assets to do that. So that was why it's so drastic. People were levered massively into the market here, and that fall from a peak of 381 in 1929 down to 41 wiped out a huge number of people. So it was a very, very drastic crisis. But when you look at it, it was probably welcomed by his parents. I don't know this. Whenever I'm not sure about it, I'll say something like probably in the text. Because they were both Russian immigrants to the United States, and they were both active in a non-orthodox Marxist group known as the Mensheviks. Have you ever heard that term before, Mensheviks? Okay. Have you heard of Bolsheviks? Okay. Bolsheviks were the dominant group, only very marginally as it happens, in Russia, and Lenin was part of that group, and they believed they could transform Russia, which was effectively a feudal society, into a socialist one by industrial planning. The Mensheviks disagreed. They thought you had to go through from feudalism to capitalism to socialism. So they were the protest group. And so they accepted Marx's analysis of capitalism, but they rejected the belief that you could make a rapid transition from a feudal society like Russia across to an industrial society by having central planning take the place of capitalism. So I don't know the actual reasons why they left Russia, but I presume it was for political reasons, to get out of being persecuted at that stage. So, but they still accepted Marx's critique of capitalism. They were still active themselves in Chicago, where they met. They apparently met at a Communist Party function. They didn't get married and come from Russia to America. They met at a social function for communist groups in Chicago in the 1920s, the 1910s. Now, you'll never find any reference to Marx in his writings, not one. And there's a good reason for that. Have anybody heard of McCarthyism? Who hasn't heard of McCarthyism? Okay. McCarthy was a weird American. If you think Donald Trump is strange, he's got nothing on McCarthy. Okay. At least Donald Trump sometimes appears to know that he's spouting garbage. Okay. But he doesn't make his garbage up. He actually believes it. This guy, Eugene McCarthy, would go out saying, I have a list of communist sympathisers, 325 communist sympathisers in the State Department. He whipped up a whole frenzy against communists at the time. There was a real witch hunt across the entire American social spectrum. It wasn't just in politics this happened. People in Hollywood would not be able to work in movies anymore. There was complete persecution of anybody with a non-right-wing American perspective. And it lasted for about 15 or so years before finally it was shown that the so-called list was totally fabricated. There were the names, he had no information at all. He was making the whole thing up. But the demagoguery got him to be very, very powerful, and he set the scene in America. So much so that if you admitted you'd read Marx, virtually in any position in society, let alone being an academic, that was grounds for being sacked. Okay? So there's no way he was going to mention Marx in any public or written down section. He'd just know he'd be eliminated from an academic position. But he would admit it in private, and this is something which I know from personal anecdotes. I met Minsky's son Alan back when I was writing Debunking Economics back in the late 1990s, early 2000s, and he explained to me that he and his dad had typical sort of father-son clashes. I'm sure some of you know what I'm talking about. So fathers often have an easy time handling daughters and they have handling sons. So there was real conflict, and Alan went into independent media rather than into economics. But in his 30s, he started getting interested in economics again. And he asked his dad one day, what book should I read first? He said, Dad went into the study and came out and gave me the book and said, this is the one you should read first. It was Das Kapital Volume 1. Okay. So he'd admit to his family and close friends that Marx was a major influence. But at the same time, he didn't follow. Have you done any reading of Marx yet? Okay. Yeah, you've I must talk about your research. You're doing quite a bit there. You read Minsky, you read Marx. Oh, okay, and with Paul Auerbach. And in America. Okay. Interesting subject you've done in that case. But there's a conventional approach to Marx that focuses on what's called the labour theory of value. There's no sign of that in Minsky's writings, and I'm pleased about it because I don't think it's a very sound argument. But I think what influenced him was Marx's writings on finance. Now, if you only read the first Capital has 3 volumes, only one of which was edited by Marx. The other 2 were published after he died, and he actually intended writing 6 books, and I regard Capital as one of the 6 books he intended writing. So nothing like complete. And in the first volume, he treated money as gold. Said gold or labour time we saw as being effectively money. But in the later volumes, he was talked much more about finance, and he was quite scathing about it. So, for example, here's one of my favourite quotes from Marx. He said that, he said a high rate of interest can indicate the country is undermined by the roving cavaliers of credit, okay, who can afford to pay a high interest because they pay it out of other people's pockets. Now, that was a classic put down you could use for the City of London today. Okay. And then he said this can actually, they said the whole returns become entirely deceptive because of the impact of the loan system. So he's definitely focusing about the role of finance in causing instability in capitalism. So that's in volume 3, chapter 23. This is the old bloke. He's always known as the Moor because he's incredibly hairy. And that's him as an old man, but you look in the youth, the same black beard and so on. Back in the youth he was more of a poet than he was an economist. So look about this, talk about centralisation. The credit system, which has its focus in the so-called national banks, constitutes enormous centralisation and gives this class of parasites the fabulous power not only to periodically despoil industrial capitalists, but to interfere in the actual production. And this gang knows nothing about production and has nothing to do with it. So I think Minsky absorbed a lot of this long before he started becoming an academic. And I lost quite there. So Minsky's focus was on the importance of finance and explaining where crises come from. And that's both experiencing the depression as a 10-year-old and also from reading Marx. Other influences on him, very important one, was Joseph Schumpeter. Anybody heard of that name before? Good? Great. Okay. And he was the main developer of what we call evolutionary economics today. And he saw capitalism as necessarily unstable, but to him that was a good thing. Okay? And think about it. A stable place means we all become accountants and die of boredom. Okay? Its stability is overrated in that sense. So he saw instability as the source of the creativity of capitalism. And what he argued was that the profit that an entrepreneur makes by coming up with a new idea, and the iPad comes out, or the iPod revolutionising music, listening to music, it disrupts the equilibrium of the system, and by doing that they make a profit because they come along with something which might be cheaper than the previous products, or much like we mentioned. Did anybody here ever own a cassette tape? Okay, and then CDs. Okay, well the leap to the iPod, where it's all the physical tiny devices, dramatically disruptive of all those other previous industries. And Schumpeter's idea of an entrepreneur is somebody who had a good idea but no money. So therefore, to get their idea into a product, they had to borrow money. And when they borrowed that money, they would spend it into the economy and cause a boom. And then the slump would occur when the products hit the market, because two things would happen. First of all, it would undermine the rival product. So suddenly the iPod turns up, and that disrupts Sony, which specialises in cassette tapes or CDs, the Walkman. All remember that technology? So that disrupts and undermines the profit of a large part of the industry. And they also start to repay their debt. And from Schumpeter's point of view, when they repay the debt, they're reducing the money supply. And I'll talk in more detail about that in a later lecture. And the combination of this entrepreneurs' activities with finance and then new products turning up in society, improving society in that sense, causes a cycle of booms and busts. Oh, by the way, if you're going to get hand cramp taking down all my notes, I'll put the lecture notes up on the study space as well, because they always go too quickly there. So feel free to take something down, but don't panic if you can't take it all down. Okay. So here's Schumpeter saying he explains the fluctuations by a chain of causation running for new enterprises, changing the possibility for other ones to come into being. And it's necessarily a non-equilibrium way of thinking, and I'm going to be taking through a bit through the fact you can actually model an economy without needing to pretend that it's an equilibrium. So here's Schumpeter talking about whether it's an equilibrium process or a disequilibrium one. He said, is it like a continuous smooth process? And he said, no, it doesn't move along smoothly. You'll have booms and busts, forward movements, setbacks, etc., etc. And that's a key part, to Schumpeter, an unavoidable part of a capitalist economy. And finance plays a key role in this, because he argues, and we've seen a fair bit of this in our own lifetimes, innovation doesn't grow out of old firms, but appears from new ones. Now, obviously Apple is not an old firm anymore, but it was a new firm in music when it brought in the iPod. Okay? Nobody, if Sony was thinking who its competitors were, it would have been Hitachi and firms like that rather than Apple. Okay, quite disruptive technology coming out of an existing firm, but an existing firm moving into a new industry. And he argued, he took the toughest possible situation for arguing how finance has a role by imagining that entrepreneurs literally have no money, and therefore to be able to actually bring their products into existence, they had to borrow it from somewhere. We might imagine they were borrowing from a venture capitalist today. And then once they had the money, that increased demand in the economy. And you had called a secondary boom. So when you got the money to develop Facebook, for example, if you go to, was it Zuckerberg? Okay. I don't know if Zuckerberg borrowed any money. I think it was, there was a bit of leverage going on there, but I think it was venture capitalists doing it rather than banks. But of course they go out and they eat pizza. Okay, so there's the demand, the money they get to bring about the new products causes secondary demand in other markets. And this is what Schumpeter saw as causing a boom. New technology coming along, requiring a setup cost to do it, buying all the products you need from rival firms, enticing people away from competitors by paying them higher wages, etc., etc. So you get an expansion in economic activity. Again, there's too much to read through and all the notes there, but given the amount I'm going to cover in this lecture. But that's the kick-off stage of a boom. But what you get initially is this positive feedbacks mean more and more products come online. So you see all the rivals that turned up for Facebook, all the rivals that turned up for the iPod and the iPad, etc., etc. And because one succeeds, then other people who come along with that same idea are more likely to get funding, okay, because people can see there's a growing market there. So one success in one industry sector makes possible for others in the same sector to also succeed in getting finance, but of course they spend their money outside that industry, so it expands the rest of the economy as well. And then when the products turn up, on the other hand, you go in reverse, because when the new products turn up, first of all, the entrepreneurs who were borrowing money during the boom are now selling the products and using that to pay down their debt. So that's taking money out of the economy, and I'll explain how that happens in a later lecture. And there's nobody to replace them at this stage. And they're also undermining their rivals. So Sony is being undermined by the iPod, etc., etc. So Sony is laying people off rather than hiring more people, and so on. So that's a cyclical view of the economy, but it's a very positive view. And he saw this being as part of the essential progress of capitalism was the cycles it would generate. But what he ignored, and this seems to be common to people from an Austrian perspective, and Schumpeter is Austrian by birth, and similar to some of the Austrian economists have you ever read any Austrian economists yet? Hayek? Okay, lots of reading. You're nodding yes to a lot of these questions here. Where did you do your course? Which university?
From the States.
Yeah, I gathered. Whereabouts? Which university? What? Oh, right. Okay. Okay. Right. Okay. Now, that's one of the major influences, which was a direct influence because Schumpeter actually supervised Minsky's PhD. So it's a very, very close relationship. A longer distance one from reading was Irving Fisher. And Fisher had a far less benign view of cycles and finance than Schumpeter did because he focused on accumulating too much private debt. So Schumpeter saw the positive from borrowing some money to enable you to bring in new products. But Fisher looked at when the whole society has accumulated too much debt. And the reason he focused on it was because before the Great Crash, he was a completely orthodox conventional economist and one of the most best known in the world, probably as well known then as Paul Krugman is today. You know the name Paul Krugman? Okay. As well known as Krugman. He also wrote a newspaper column in the same newspaper, the New York Times. So he was publicly known. And he was a bull on the stock market, and he was convinced that the valuations in 1929 were completely justified, and he had taken out margin debt. Okay. He had about $100 million worth of shares, and he lost the lot. Okay, completely wiped out. So, but before it happened, literally 8 days before the big Wall Street crash when it fell 10%, he wrote this in his column. It was actually quoted from a speech he gave to bankers. It wasn't what he wrote in his column, but it was quoted in the New York Times to reassure people that the decline which had already started was not going to continue, the market was going to recover, don't get out of the stock market. Fabulous advice. Okay? So he said stock prices have reached what looks like a permanently high plateau, and he then said, I don't think there will soon, if ever, be a 50 or 60 point break below present levels, such as a rival bear commentator had predicted. And he said, I expect to see the stock market a good deal higher than it is today within a few months. Well, he was abjectly wrong, and he was financially wiped out by the crisis. It lost 10% in a single day. Okay, and then it lost more the next day after that, and so on and so forth. So ultimately, over 4 years, the market was down 90%, and he had blown $100 million worth of assets because he'd leave it up. He had about 10 million of his own money, leave it into 100 million completely wiped out. He'd only saved from bankruptcy because his wife's sister was very rich and she lent enough money to pay back his debts and then forgave the debts to him on her deathbed. Now, he was, of course, ridiculed for those wrong predictions. But after the experience, he went back saying, how did I get it so wrong? Okay? How did I completely fail to see this huge crisis? What was the problem? And he developed what's called the debt deflation theory of Great Depressions. And what he did in this theory was he say, well, the neoclassical theory that he was the leading exponent of at the time assumed equilibrium. He said, but in the real world, even if you're in equilibrium, there's going to be a disturbance. So he said, any variable is almost always going to be above or below its ideal equilibrium. He said, theoretically, therefore, there must be over and under production, over and under consumption, over and under everything else. In other words, he's saying even if you believe in the supply and demand idea, and you argue that the market will tend towards the intersection, there's going to be something that shocks the system, and it'll move away from it. So he's saying you can't take equilibrium as your reference point. You've got to start from non-equilibrium. And he's not a particularly poetic writer, not like Keynes or Marx, but he did write this one rather well. He said it's absurd to assume the variables in the economic organisation will stay put as it is to assume that the Atlantic Ocean can never be without a wave. So he's saying you have to think in a non-equilibrium way. And he saw that as the rule for the markets and developed the disequilibrium theory of what caused the Great Depression. And he saw the two dominant factors being over-indebtedness at the start, so too much debt, and deflation, so inflation being low or negative. And this is actually, I find this incredibly poignant because he's really talking about his own personal experience here. He would have been homeless if Columbia University hadn't given him a house to live in after the crisis. So it really was quite that severe a shock for him. So he said, over-indebtedness and over-investment lend importance. And the same is true of overconfidence. He said, I fancy that overconfidence seldom does any great harm except when, as, and if it beguiles its victims into debt. Now he was seeing himself as a victim of overconfidence. There was really a very personal set of lines there. So what he saw happening when there was, having had general overconfidence, and think back to the Roaring Twenties. You know the scene of the Roaring Twenties? The Charleston, gin parties, etc., etc. He said once you've got that overconfidence that's led to people in general having too much debt, you'll have a chain reaction. So the first thing is people will be forced to sell, distress selling, and when they do that, contracts the amount of money in circulation, so bank loans are paid off, reduces the amount of money in circulation, and it also slows down the rate at which money turns over. Prices fall, and with the falling prices, the net worth of companies falls as well. Profits fall, which means the firms that are investing cease investing. They reduce output, they reduce employment. Pessimism increases, and people start to hoard, which slows down the circulation of money even further. And then he finally says complicated disturbances in the rate of interest. So a fall in the nominal rate, which heads towards zero, but the real rate, which takes into account inflation, actually rises because rather than inflation reducing the cost of interest, it's deflation. It makes payment of interest harder. So that was his verbal vision. And Minsky was trying to bring all these together in his PhD thesis. So he wanted to, first of all, make it systematic. How do we understand financial instability? And then explain why it hadn't happened between the 1945 and the mid-1960s. And he put this again, I think Minsky's a beautiful writer, but one recommendation I'll give straight away, do not read Stabilising an Unstable Economy. That's his most well-known book, simply because it's got a good title, and it's the last thing he wrote. I think it's a dreadful book. He wrote one book before that called John Maynard Keynes, which sounds like a biography to most people. It's not. He just chose that as the name as a tribute to Keynes. That's the best statement of his theory in a book-length treatment. If you want to read a shorter one, there's a set of essays called Can It Happen Again? And they're very readable. I really highly recommend those if you want to follow up on this. But this is taken from Can It Happen Again? This is the most significant event of the era since World War II is something that has not happened. There has not been a deep and long-lasting depression. He said, looking at the history before then, leading up to 1929, to go 35 years without a severe depression is a huge success because they happened every 10 to 15 years in the 19th century. If you look back in the 19th century, there was a bank run, a panic, a crisis, a depression, every 10 to 15 years, pretty much. So to go 35 years without one was quite remarkable. So he said there's something about post-war institutions we designed after the 1930s that made the system much more stable. Now, what he was trying to do in the PhD was to go from a verbal understanding of all this to a mathematical one, because he'd done a mathematics undergraduate degree, and he developed a mathematical model, but he hadn't read Keynes when he started doing this. And this is something, again, I recommend to all of you. If you want to continue working as an economist or thinking about economics, never rely upon textbooks. Okay? They're dreadful. He just relied upon the textbook version of Keynes, which was Hicks's ISLM model. Have you done ISLM? Okay, some of you have, but most of you haven't. Okay. It's a supply and demand model of the macroeconomy, effectively. What he also used was a model from the same guy who developed ISLM, who was a guy called Hicks, not Keynes. Hicks also had what he called a multiplier accelerator model of the trade cycle, and that's the equation there, and that simply says that output now, which is Y at T, so the output this year, is going to be some function of output last year minus another function of output the year before that. So it's relating output this year to what happened in 2014 and 2013. And this alpha bit here is what's called the multiplier. Okay? You've done the multiplier analysis? Okay. And this bit's the accelerator, beta. And the model was known to have explosive characteristics when you had a high value for the accelerator. And most models treated it as a constant. What Minsky did was say, well, let's make it a variable, depending upon the expectations that entrepreneurs have, because he wanted to have a turning point in this particular model. And he made it fall as the economy grew, which would give a turning point. So he said the accelerator coefficient is based partly on the productivity of investment, but it's also based on the willingness of investors to take risks and how they can finance. So he's talking about expectations of investors, which will make them willing or unwilling to borrow money or take risks, and whether they can get finance to do it. That's tied up there. Now, the model was useless, and I can explain why. In a more technical course, I can explain pretty rapidly that the actual foundation model was a logical fallacy. It wasn't a model of a trade cycle at all, so it was never going to work. But it was also based on a textbook reading of Keynes, and you can find this in his writings after his PhD. He said, if we make the Keynesian assumption that consumption demand is independent of interest rates, but assume that investment demand, and hence this beta coefficient, depends upon interest rates, he said, then a rising set of interest rates will lower beta. So what he's saying is investment is driven by the rate of interest, which is, if you look at what you're doing in even the multiplier model, but certainly in ISLM, that's what you're still taught today. Now, that's what Hicks developed as his model of Keynes. But in 1937, by sheer chance, Minsky read some short papers by Keynes. He didn't read the general theory at this stage, but he read a couple of papers, one called The General Theory of Employment in particular. And having read that paper, he was stunned by how different Keynes, as he actually wrote, was to what he was told Keynes was like in the textbooks. And he said, my interpretation of Keynes is not the conventional view, which is mainly derived from Hicks. He said, and he thinks Hicks's article misses Keynes's point completely. So he completely rejected the textbook approach to macroeconomics that's still being taught today. Now, he largely abandoned thinking mathematically at this point. He started developing this verbal model as a blend of Marx and Schumpeter on instability, and Schumpeter on the ability of banks to create money endogenously, which I'll talk about in more. I think Devon has covered some of that. Yeah, I'll cover more detail on that in one of the final lectures I'm giving. And Fisher on debt deflation, plus Keynes on how investors behave under uncertainty. So I've covered Fisher and Schumpeter, and I'll talk a bit about Keynes, because The standard stuff you still get in textbooks today is more due to John Hicks. Okay? If you read the general theory, it's a bit like reading the Bible, or I don't know, but not quite like reading the Quran. The Quran is rather more tightly written. But if you read the Bible, you can find things in favour of and against virtually everything. Okay? It's so with the general theory, there's tons of stuff which is conventional. There's a couple of tiny parts, particularly chapter 17 and also chapter 12, where Keynes starts to think in a different way. And what he says in this particular chapter is that investment is motivated by the desire to produce assets where the supply price is less than the demand price. So you can make a profit by producing them and selling them. And he saw the supply price is determined by the cost of production, whereas the demand price was determined by people's expectations of what profit you can make out of that asset. And that involves expectations of the future. So he ended up saying there were two price levels in capitalism. Normal commodities, goods and services we normally buy ourselves, which are based on a markup over the cost of production, and assets which are based on where the price depends upon people's expectations about an uncertain future. Now, there's a touch of that in the general theory, but there's tons of it in this 1937 paper, which I link in one of the slides here. And here in talking in 1937, he says the scale of production of capital assets depends, of course, on the relation between their cost of production and the prices that they're expected to realise in the market. Now, this actually was quite a breakaway from the thinking he was doing in the general theory, because you can't get that sort of difference in prices when you think in terms of marginal cost and marginal revenue. It's a different way of thinking about how prices are set. And when he looked back at his previous way, which involved this thing called the marginal efficiency of investment, he said that to actually believe in this, you had to imagine you could rationally predict the future. And he said, but we can't do that. There's uncertainty. The future is not risky, it's uncertain. And the things which determine your expectations, there's just no way of knowing what's going to happen in the future. He said, we simply do not know. Now, what's uncertainty? Anybody think, can you define uncertainty? Can you define risk? Okay. Risk you would have done, probability. You know, if I toss a coin, what are the odds of it turning up heads? 50%. What are the odds of tails? 50%. Is there any other possibility? Okay. In the weirdest of worlds, a coin could land on its edge and stay there, okay? But it's so vanishingly rare you can rule it out. And you can use mathematics to work out whether you'll take a gamble over the numbers that will turn up on a dice or roulette wheel. All those things are subject to odds. And what he did in the general theory was give all these examples of what uncertainty is not. So he said, by uncertain knowledge, I don't mean what is known for certain from what is only probable. He said the game of roulette is not uncertain, or even whether a bond's going to be drawn. Even your life expectancy is not uncertain, because we can use actuarial tables to roughly predict life expectancy. He said even the weather is only moderately uncertain. He said the sense in which I'm using it is whether there's the prospect of a European war, or the position of private wealth owners way in the future, like 1970, 25 years after he was writing. And then he said about these matters there is no scientific basis on which to form any probability whatever. We simply do not know. Now that's a negative example, and I find negative examples don't work. I don't find them very helpful. So I just got to make a point here. This example I'm going to use came from one of my students in a presentation back when I was at the University of Western Sydney. And she told me later that it just occurred to her while she was giving her presentation. Very theatrical girl. And she hopped up on just came up with this, literally talking to the audience and looking at her. And she said, imagine you're attracted to someone, and you know that person has accepted 1 in 5 of the dates they've been asked to go on in the past. Does that mean you've got a 1 in 5 chance of success if you ask her out? Or him? Okay. What do you reckon? Absolutely not. Okay, it's obvious, because whether you're attracted to somebody is not a probability thing. Each case of attraction is unique. And what they've done in the past bears no relation to how they're going to react to you. Okay? That's uncertain. Okay? You can't use probability to say whether the person is going to say yes or no. Okay? And the same thing applies with investments. Whether a past investment has been successful will give you no guide to whether the same investment will work in the future. And how do you handle with this sort of stuff? What do you do? Well, you think about relationships. You try to find out whether friends think that she thinks or he thinks that you're an interesting person. You get paralysed and do nothing at all, or you ask anyway and take a risk, or you follow conventions. You go along to parties and stuff like that and hope that something happens. Okay. That's the real nature of uncertainty. So investors in the same sort of story, they can't know what's going to happen in the future. So they form expectations about the future, and those expectations will be manifest in the prices they're willing to pay for assets now, but they'll be incredibly fragile. And there'll be really sudden and violent change in those prices, which is what we saw back with the stock market crash in 1990. But we've seen it ourselves in the last few years. And when that happens, people's willingness to invest will also change very, very radically. So the whole idea of having a marginal efficiency of investment, which was the stuff he had in the 1936 book, The General Theory, assumes you can actually make this calculable guess about the future. Now here he's saying you can't do that. Okay? So what do you do instead? Well, he said, first of all, what you'll do is you'll tend to project forward what's been happening recently. He said, you'll presume the present is a much more serviceable guide to the future than a candid examination of past experience would show it to have been hitherto. Now, at one point, by the way, Keynes is a beautiful writer. When he writes well, he writes brilliantly. So this is one of the best phrases. He said, we will believe that the existing state of opinion, as expressed in asset prices, and the character of existing output is based on a correct summation of the future prospects, so we accept current prices and just go along with them. And I love this one. We endeavour to fall back on the judgment of the rest of the world, which is perhaps better informed. So we have herding behaviour. Okay. Now I think that's a brilliant understanding of why expectations are so fragile and why they'll change so much. And that, of course, affects how the price you'll put on asset prices as well. So Minsky said his ideas in 1969, having not read Keynes when he did his PhD or undergraduate degree at all, only finding reading Keynes in the mid-60s by accident, and then suddenly finds his views are very consistent with Keynes from 1937, and he finally argued, this is his perspective on capitalism, it's inherently flawed, being prone to booms, crises and depressions. He says this instability is due to characteristics the financial system must possess to be consistent with full-blown capitalism. So it's not something it can reform out of existence. He said such a system will be capable of generating signals that are generated an accelerating desire to invest and also financing that investment. And he eventually developed what he called the financial instability hypothesis. Entirely verbal. Bad news, I'm going to turn it to mathematics in the second half of the lecture. Okay. But what it did was combine this vision of Marx, Schumpeter, Fisher, Keynes, and also Koleski. I haven't had time to go into Koleski here, but that's also part of his thinking. And to go through again, Minsky, when he writes well, writes beautifully. He can write very turgidly, and unfortunately, Stabilising an Unstable Economy is a very turgid book, which is why I don't recommend people to read it. But this is some of the strong stuff. So he said the natural starting place for analysing, notice this, the relation between debt and income.
All right, I'm going to
Every other theory of economics will tell you there is no relationship.
Thank you very much. Perfect place to stop, actually. And thank you very much, James.
No problem.
Let me ask if there are any other queries or questions before we stop the live stream.
So something happened back in 1929?
Well, it looked like it had the potential to happen even in 2007, 8, and 9.
Well, yeah.
And enough of it happened to make people very scared, which is why kind of people are, get crazy. Like they got crazy 2 days ago, and Trump sent out a posting that the sky was going to fall because the Japanese markets were just correcting. They were just correcting. You have profit taking and stuff going on, but Trump decided to start a scare in everybody, and so the market dropped 600 points, whereas under Trump it dropped for many times down to 1,000 or 2,000. It dropped that much in a day. So we should just be all very careful about these matters. Yeah,
I'm sure in the future he will be very careful and won't say something incendiary like that again.
Christ. I think everyone knows how much full of crap he is. So that's kind of nothing happened I mean, there was a drop, but it's more about a short-term profit taking, and the market's back up again. So it's just stupid. Yeah. Anyone else? This shows, and I'm glad that Keene talked about it. That Minsky sort of never talks about Marx, but essentially he's doing what Schumpeter was doing, who does talk about Marx, but he was at Harvard and sort of no one could touch him for a variety of reasons, owing to everyone's history on the continent. So this is the kind of story that economics has gone into. Minsky is not taught in the standard curriculum, at least, and even especially at the undergraduate level. Teaching Minsky at the undergraduate level would cause people to ask too many questions, I suppose.
Oh yeah.
The Hicks model is still taught. It's never not in a economics textbook, regardless, in the American context. Fortunately, in other places, other things are actually taught, but you'll find that the standard curriculum, particularly because the influence of Austrians, with all due respect, there's Austrian economics, which is what the libertarians like to follow, and
bloody Hayek.
Hayek, right? Von Hayek or Mies and Hayek, much trouble, but they're very ideologically committed to that. And unfortunately, some of the major oligarchs in America are very committed to this. That is, like the Kochs, who, and then if you go to the Cato Institute, which is financed or is created by the Kochs, and then of course Koch money goes to certain universities, George Mason, University of Florida, etc. So you have this ideological position that is kind of fixed in certain American universities, with all due respect. So,
well, luckily, the views of the Cato Institute are more than balanced out by the views of the Green Hornet Institute.
And they both wear masks.
Exactly.
So
who is it who said when my shoe shine guy is giving me stock tips, it's time to get out of the market? Wasn't that a famous quote from somebody?
I know who that is. Not Steve Forbes. Anyway, so we'll look at more of this, and you can always go to the links yourself, and because I like that Steve Keene does an entire section doing the narrative version, and then he goes to the math. So this is important. The math is actually, with due respect, is actually a little complicated. So, and you have to sort of think in big differential equations and partials and other things, and have some real analysis experience. So anyway, with that being said, I will shut the live stream down. Tomorrow.
I had a question.
Oh yes.
Sort of along the lines. So we'll get to hear Keene at the next class unity session, right?
I think so. I can't remember whether it was this coming one or the one after that. I think it's in the schedule.
Yeah, I think I said the 6th week. But so Marx's labor theory of value is an alternative to value coming just from prices, which is like orthodox economics, right?
That's correct.
And then so Keene's got this critique of labor theory of value, saying that they're not equal. Labor and there's something else. Is he saying there's something else, or is he saying, there's something completely different?
It's not completely different, but it's just a poor measure of all the activity that goes on. It kind of mismeasures, as it were, capital. Capital's more important. That's kind of why Piketty does what he does. That's why post-Keynesianism, doesn't accept a Marxian position.
Cool. Okay.
And you could say it's overdetermined in the sense that, ideologically speaking, the commitment to class struggle and all that other stuff does have its basis in a kind of labor theory of value, even though it really doesn't. But that's the break point between the orthodox and the heterodox in terms of Marxism. I mean, there's orthodox and heterodox economics, but within Marxism, there's orthodox and heterodox as well. Seriously, there's a
Yeah.
whole dialectical materialist thing that is kind of slavishly devoted to, you know, kind of, with all respect, Stalinist kind of perspectives, and you know, I mean, Stalinist, you know, in a I will, well, I don't want to get into a thing on it, but but you can see the difference, and some people are very committed to that because if you do all this other sort of analysis of capital, or you emphasize the bigger problems because you can actually measure capital better, then you can make these kinds of analysis. Now, as I've said before, I think that Paul Koschott tries to reconcile the two, and he tries to do it mathematically. And I'm not sure whether, well, I think that he can, and I think that we can, but that doesn't mean that labor theory of value is a perfect alternative. It's not one or the other. It is a combination of things. That is, this is not to accept the notion on the neoclassical side of human capital, but rather to sort of say there's just a lot more stuff there than just simply labor. Let's put it that way.
Yeah. I can think of another example of, you know, people on the Marxist, you know, side not getting along, like the Bolsheviks and the Mensheviks, right?
Well, it gets down to that because it is a kind of view of history. Is it evolutionary or is it revolutionary? And, you know, that's the push and pull, because even Marx was evolutionary when you look at Engels, etc. You know, the eco-socialist model shows that we should be more evolutionary than revolutionary, because revolutionary means it's going to be really difficult and probably awful for, you know, and it could be actually terminal, you know. I mean, if you took a certain model about, you know, that the only way that you could have global communism is by wiping out capitalists, you know what that can lead to, right?
Weapon of fallout.
A lot of fallout, indeed. And yes, if you're truly committed to the position, that could have been what happened. But you can see that smarter people prevailed. Let's just put it that way. So, as I said, I'm more ecumenical about it. I think that you can do labor theory of value at certain levels, because I think it actually helps explain certain things. But at another level, it's the difference between Newtonian and Einsteinian physics, for example. You do need a better theory, and the better theory will account for what Marx didn't fully account for, and that is the labor production of knowledge, a labor theory of knowledge, which isn't fully adjusted in the Marxian sense. Well, that would be my explanation of it. But anyway, that being said, I hope that's a satisfactory reply.
Yeah, thank you.
Anyone else? Okie dokie. Let me shut down the